Hello everybody, Average Gamer. Welcome to another investment video. All my stocks have paid out this month, so I thought I'd go over a few things and answer some questions. So people have been asking me to do a video specifically on kind of an intro guide, an intro into investments, how to kind of get into investments and like a kind of a beginner step, like what should I do at the beginning? And I'm gonna tell you now, the first thing you need to figure out is how much you're willing to invest. And how often. So you're going to do it monthly, every 2 months, every 3 months, every paycheck, so 2 times a month. Are you going to be doing it where it's set up, for example, to do a DRIP or a dividend reinvestment plan, where basically your stocks, when they pay out their dividend, basically just buy more stock of that stock. So say for example, one of your stocks pays out $200. You tell your bank or brokerage that you want, whenever that stock pays out, just to buy itself more. That's more for like dollar cost averaging, because basically what you're hoping is that as it buys automatically for you, as stock prices go down, you get more. But then there's the caveat of as stock prices go up, you get less. So there you're looking for basically dollar cost averaging. You want to average out your bang for buck, and you're hoping that you buy equal high and equal low, basically. So you're hoping that for every dollar you spend down, you also spend theoretically every dollar up. But you're also hoping for maybe an extra $1.50 when it's down versus $1 up. So you're hoping to average out your overall costs to minimize your risk, which is another thing you need to look at. Before you invest, you need to figure out how much money you're willing to risk, and if you want to go for high risk stocks, medium risk stocks, or low risk stocks. What I'm going to be doing is showing you guys how I look at a few things and figure it out. There's basically, I think, I'm trying to remember the name of it, but there's basically a metric. I think it's the base metric, or yeah, I think something like that, where basically you can see how volatile a stock can be, which I'll get into momentarily. But yeah, so first thing you want to figure out is how much money you want to put in to start, and then how often you want to put it in, and then your risk, high, low, or medium. After that, then you can decide, okay, well, now I need to look at stocks that fit my criteria. So do I want, so say we were like, okay, do you want to do that where you buy stocks high or low, or high and sell low, buy stocks low and just sell high, just make money off the dip, as it so speaks, where the stock price dips down, you buy it, it goes up, you sell because you make money on the stock? Or are you looking for more of a passive income, aka dividend stuff, like the stuff I do? So with all that out of the way, so we've decided, say you're going to spend $100 every paycheck, or $100 a month. You've decided you're going to do it every month. So every month you're going to put in $100. You've also decided that you're going to manually control your investments and not do the dividend reinvestment plan, or the DRIP as it's nicknamed, for dollar cost averaging. Instead, you're going to manually do. So that's how I actually came to how I am doing mine. I looked at it as I didn't want to do dollar cost averaging as much. Mind you, sometimes you'll do it on your own and you'll just see the way things are going. You'll kind of average it out for yourself. But in the overall grand scheme of things, you'll figure out the best strategy for you, like looking at certain companies and stuff. So what I'm going to do is I'm going to go over the steps of just selecting a stock, which, I mean, that is the first thing you got to do, right? You have to pick a stock that you want to invest in, and I'm going to show you the tool I use to pick a stock. Simple as that. So I use a website called Simply Wall Street. Now this website has multiple different connections to multiple different stock exchanges and things like that. Overall, it's got amazing options, but the main reason why I use it is for the screener and for the tracker. Now, mind you, it's about 150 Canadian annually to have the website. So I personally have what's called a learner plan, aka a free account, because I couldn't at this point justify $150, or if I average it out per month, to $12.50 a month. The way I look at it is, right now my investment portfolio isn't big enough. My own personal one, which I'm not going to show you guys, um, unless I misclick. Luckily enough, it doesn't track all of them on here. It only tracks, I think, 6 of the 9 that I have. And even then, I think some of the ones on here are out of date. Actually, I'll probably show you, actually. So you can go to your portfolio. Like, here's mine. Apparently, this is 8 holdings of mine. Yeah, I don't have this one anymore. I don't have this one. And I don't have this one. I have this one. But yeah, I got a whole bunch of different stocks. So that's actually not so bad. So, as you can see, it also tells you your overall, theoretically, your situation for your stock account. So the way I look at it is, I look at this as my guide. So right now, on a scale of 1 to 6, when it comes to value, my current prices for all the stocks, the 6 that it's tracking, and of the 6, 4 I don't have anymore, it says the current price I'm paying for those 6 stocks is $123.01. The fair price or fair value for them is around actually $1,000. Now, mind you, COVID-19 made everything go down, so that actually makes sense. And things are slowly climbing back, but it's going to take a while for them to climb back. So right now, basically, you're buying in a big dip, like a year-long one. But yeah, so this shows you your own account and the way it's all set up. Now, mind you, like I said, free account, so it's not tracking all my stocks. And like I said, I got twice as many stocks as I actually have on here. So this numbers are obviously incorrect. But it shows, your earnings, the company's earnings and things like that. The expected growth. So, your portfolio is expected to grow, in this case for me, 0%. Well, 4 of these companies aren't on here, so no big deal. And the overall the market, in my case, the TSX, or the Toronto Stock Exchange, is expected to grow at a 1.2% rate over the next little while. I think it's on the next year. Theoretically, my portfolio is not going to grow at all. No big deal. Like I said, a lot of these stocks aren't even on my thing anymore. Overall value of assets, my portfolio sits at 1.3. The market, on average, is at 2.4. Not so bad. Future growth. So right now, it's telling me that the future growth, or annual growth earnings for my stocks, is going to be 114.5%, probably over the next year, which makes sense because all the stocks dropped. Some of the stocks I was looking at, they were $6, $7, and then last January happened and they went down to $2. So that kind of makes sense, right? Everything's going to kind of probably go back up. How long? It might take a while. No big deal. That means we just get more bang for our buck. It shows overall past performance, the overall return on assets, capital, etc., etc., etc. Overall financial health. So overall, very, very good feedback. It's limited, obviously, as you can tell. It says right now it's only tracking 3 of these stocks, right? It's only tracking DE, SGR, and DIV. So it's no big deal to me. The way I look at it is, well, yeah, like there's not much to expect because it's not tracking all my stocks. So there you go. It shows overall the diversification of your stocks by company. So pretty much every stock on here has almost a 14 to, I think, well, this is the only one that's a little bigger, $47. So I like how it breaks everything down. It's pretty good, but like I said, it's kind of on the expensive side. $12 a month. Only way I would actually invest in this is if I was making more than $12 a month on my stocks. Personally, I would probably sign up for this website anyways, just because the sheer amount of information it's providing me, and the amount of information it provides is pretty amazing. It shows you also your portfolio beta. So this is the overall volatility. Basically, the market average is 1, meaning the market average means this bit, half the businesses sit on this side, half the businesses sit on this side right now. The further to the right you are, the more, or the lightning bolt, the more widely the prices in the stock change. Basically, the more it goes up, it goes down. The further to the left it is, the more the stock just kind of stays, just keeps going. Just like me, I'm $5. Oh, I'm $5.02. A couple months later, oh, I'm $5.01. It's pretty steady. You there is a beta which I'll show later that you can calculate it. Shows you news of anything that you have set up and things like that. So overall, very good website for very, very good feedback. Like I said, it for the beginner where you only have like 2-3 stocks, very good website. Once you get above the original, the base 6 though that it tracks, then it starts getting a little crazy. Like for example, it tells me I have $47 holding in sgr.un. It's actually higher than that because you have to actually select these and add a portfolio and say, hey, I bought. Oh, oh what? Oh, you go to portfolio, select it. We go to it here and say edit transactions. Hey, on today's date, the 18th. Well, actually, let's do you'd say the 15th of January 2021. I bought 6,500 shares in this company at a cost of $11.81. No, actually, I got a little bit more on the expensive side. Unfortunately, I got it at 86. So I got it 5 cents higher than it was supposed to be. Cost $70,090. Add it to your account. There you go. You click over here, and now it says, "Hey, look at that! You have $76,000 in SGR.UN. Overall 7-day return is 1.9%, or price is 1.9%, etc., etc., etc." Like I said, very good for beginners if you only have 6 stocks or 2 stocks or 1 stock, because you can, try things a lot easier, and I like it. But like I said, that's not the main reason why I use the site. I use it for the screener. So the portfolio screener is actually really nice. What you can do is you can actually cut it down to specific stocks that reflect your investment strategy. So right now, obviously, because in Canada we have a stock tax associated with Canadian stocks. So if you invest in Canadian stocks specifically, it's 38% tax. If you invest in taxes that are non-Canadian, it can get up to 42%. So you kind of save a little bit of money by keeping your money in the country, which is cool. What we're also going to do here is look at some of the stuff. So here, what you'd want to do is say, hey, I want a company that has at least 800 million American. We'll actually lower that a little bit because Canadian stocks. So 700 million market cap. Now, what the market cap basically says is the larger the market cap, that means basically the larger the business. The larger the business, the more stable they are, basically. So we're telling the system here, hey, market cap. So I want businesses that are, let's just say, not lucrative, not relative, but they're stable. They're established. They are established companies with established things going on with them. So now what we're going to do is we're going to look at this, or we're also now going to add in what's called the beta. So what you'd want to do, kind of start, you want obviously stuff that are going to be stable. So what you'd want the 5-year beta to be is 1 or less. Basically, less is better in this case. You want companies that obviously are very stable and their stock price is rather stable. Times like now, not so much, but well, especially times like now. Some of these validation stuff like PE and PB and all that stuff, I honestly don't really worry too much about that. But something with a very good beta, basically a stable stock, something that kind of stays good. And then you can play around with this. So this is what we're going to do. We're going to look at a company that's healthy. We're going to give it, it's got to get at least a score of, I think it's 1, 2, 3. A 3 out of 6 on health. We want something that's got a 2 out of 6 for its future, and something that pays 1, 2, 3, a 3 out of 6 in its dividend. So what we're going to do here is we're going to look and kind of go around the system a little bit. So we're going to look at some of these businesses, and we have a company called OpenText, BCE or Bell Canada Enterprises, Bank of Nova Scotia, Canada Railway, Intact Financial, Maple Leaf Foods, and Everett's Technologies, which is cool. So we can look these companies up, but we can also say, well, hold on, I actually want something with some value. Okay, well, that's narrowed things down a little bit. Now, this will also tell you here that, there's additional stocks not on your list. So we kind of were able to weed off 2 of those companies. Okay, cool and all. Well, now we're looking at BCE. BCE really isn't where we're going here. We want that, passive income. So we're going to go up a little bit more on a 5 out of 6 on the dividend scale here. So now we've got Bank of Nova Scotia, Intact Financial, and Maple Leaf Foods. So what I'm going to do is come in here and look, and I'm actually going to close that page so you guys don't see my stocks here. And we're going to look, and we're going to say Bank of Nova Scotia, which I already know is BNS. We're going to look at them and say, let's see what's going on. So firstly, it's $70.21. So one of the things you need to contemplate now, if you're thinking of buying this stock, is how much does it cost to buy? For me, it costs $9.99 per stock or per interaction. So if I buy one stock, it's $9.99. If I buy 100,000 stocks, it's $9.99. One of the things to look at sometimes is to figure out how long it will take monthly for the dividend to pay off the cost of buying it. That's some of the time, that's usually what I look at. Like, how long does that stock take to pay off the $9.99? Because after that, it's gravy. So here we're going to look at the Bank of Nova Scotia over the last year. And just like everyone else, big poop back in March. Okay, cool. No big deal. Back in March, it was, what was the price? High of $50. Low of 46. Cool. That's where the H and the L is. All right, cool. No big deal. It was down 3. What have you. No worries there. So we can kind of hover like, you can kind of hover like this, but I just like to just kind of go this way, left to right, and then looking at these numbers up here. So that's overall or high, low. I can't remember what that is. But yeah, so we're just going to kind of go over here and be like, okay, well, at its low, it was at $46. Cool and all. Right now it's at 70. Prior to all this craziness, it was sitting at around $70. Cool. So it's probably going to go up another $4 or $5 at least, and then it'll be funness of 2020. It'll just be pre-2020 prices. Cool and all. It's also a bank, so let's look at the last 10 years, and it's probably going to be just steady, slow income. So I usually look at the beginning of the 10-year gap, where here it was at $50 or $60.02. Now it's 70, so it's originally higher, and if you look, it kind of went up, went down during the little economic bump we had back in the day, came back up to 2015, went back down in 2016, skyrocketed up in the 2018 era, and then obviously had a, it was already in the midst of going down. So theoretically, it may have gone down, maybe not too far. So overall, it's a bank. It's pretty steady. Well, now we got to look at what it pays. So right now it pays quarterly at 90 cents. Okay. So the annual yield for the interest or for the dividend is 5.1%. Cool. Throw that in our calculator real quick. It pays 90 cents. We divide that by 3 because there's 3 months on a quarter. It pays 30 cents a month. Okay. If we bought one stock, we would make 30 cents a month. So if we do that divided by 9.99, whoops, it's 9.99 divided by 0.3. So we're looking at 33.3 months to pay off for that $9 fee. Cool and all. Now, obviously, the more stock you get, whatever. But we're looking at a 33-month run to pay off our $9.99. So that's one of the other things I look at when initially trying to buy a stock. When getting into things, I also did a lot of homework on things that were cheap. So, for example, if we went to, I think it's, if I rank the value up here all the way. Whoop, no. Bring the dividend down. Bring the future up. And bring the health down. Oh, interesting. Well, we still want dividends, so we're going to go like that. Bring the value down. Well, 3 different companies there. Well, we're not too worried about the future at the moment. How about we go for past? Get a company that's got a good past of paying out dividends. Everything else can be okay. Well, there's Intech Financial and Maple Leaf Foods. Well, let's look up Maple Leaf Foods here. MLF, or MFI, sorry. Okay, well, they're down right now. Cool, but they're 26 cents. It's almost a 3-for-1 deal if you compare it to the last stock we just looked at. Now, if you look, yeah, that's this already right here is not a good thing. It's going down. Interesting. So what is going on with you? Well, let's look at the 10-year thing first. All right, so overall you've been going up, and then around 2018 you started trending down. So they're right there, kind of historically, yeah, you've done good, but now you've been, since 2018, we'll say, it's been slowly just petering down. Like even before COVID, when COVID happened right over here, you're at 23 bucks. At your high, you're at 36 bucks, basically $10 more than it is right now. Okay, well, what's going on? Well, 16 cents quarterly. That's 2.4%. That's not bad. That's not bad. If we theoretically, so the other one was 3 cents a month at one stock. Well, hold on. Now this one is basically 3 to 1. So we did 0.16 divided by 3. Cool. And then we multiply that by 3 because we're doing 3 stocks. Well, actually, we'll earn 16 cents every month per stock. How long would that 16 cents take to pay off? Well, $9.99 divided by 0.16, 62 months. It's double what it was before. Sometimes these numbers, very how can I put this? The numbers, sometimes you have to do the math to figure it out. So yeah, so these are some of the stuff I have. Now, if I can actually bring up some of the companies I looked at. No, that's not what I wanted. Can I not bring up my stocks? Oh. Symbols. You're not going to give me... There we go, view company. Really? Okay. Well, I'll tell you guys about the company I just bought. So, the company I just bought is PFB Corporation. So we bring up PFB. Boom. So this is PFB Corporation. These are a polystyrene expanded materials construction business. Basically, they produce polystyrene insulation and things like that for commercial, residential, and industrial use. This is the company that I just looked at, and this is actually the company that I recently just bought into. So if we actually look at our current numbers here, So last month we received roughly in dividends and stocks sold $297.37. That's the full amount we brought in last month, plus $100 that I'm throwing in this month. It brings us up to a $401.68 additional amounts we can buy. Now, why is this important? Because this stock pays only $2.13. I also didn't finish putting their name on this right here. Wait, what? Oh, because I could probably just do this. Shift C and then just go boom. There we go. So yeah, they only paid $2.13. But I was looking at some of their information and I was like, oh my god, the value is amazing. On a scale of 1 to 6, fair value for their stock price, obviously COVID, it's around 56 bucks. They're sitting at $22, 60% undervalued. Very, very good. Anything sitting at, in my eyes, 50 or less or more, very, very good. They do massive checks for stuff like that, and it's like, wow, like, it's, yeah, this is one of those stocks where I saw it and went, oh my gosh. So 60% undervalued. Cool. What's next? Well, it's earnings. Its PE ratio, or price per earning, compared to the overall building industry, is higher. The company is sitting at 9.9% PE ratio, or price to earnings. Basically, how much the company earns versus how much a stock costs, or how much the stock is at 9.9. The industry is at 23.6. Cool. But the overall stock market is at 16.6. It's very good. Next, price per earnings. So how much money it makes for growth in earnings for the price. Right now, it's quote unquote a good price. The reason why is because the company is sitting at almost 1%, which is, or almost sitting at a 1 times, which is very, very good now. That's because the dividend is low, but this is one of the rare companies that pays out an extra dividend. That's why this is interesting. So technically it's low, but they pay out extra. If they do very well, they give it extra money. How many companies do that? And this one does. And there's a reason for it, which I'll get into momentarily. For the price to book, now this is one of those ratios that I honestly don't know much of. But apparently compared to the industry average of 2.9, it sits at a 2.3. I have no idea what this is. I think there's a... So the share price is 22.43. The average book value of the share is $9.72. I'm assuming that is, well, this is back from September. So I think they're saying is the overall value back in September was $9. Its overall value as of 2 days ago was $22.43. The overall industry average is 2.97, whatever that means. Overall, here you go. It actually explains. So the PB ratio is the price per share divided by the book value. So if we take that number real quick, and I like how it also explains these things. I don't know what it is, right? So we take 22.43 and we divide that by 9.72. We get 2.307, blah, blah, blah. So 2.3. So basically what it's saying is the value per share back on September when the company did some filings in 2020, it was $9.72. As of a couple days ago, it's now $22.43. So it's saying basically it's grown, I'm assuming 2.3%. And then it gives you the ability to, look that up. Yeah, here it's just saying, hey, if you're interested in this company, take a look at some other ones. Because hopefully you'll click more than 10, and then you got to pay us for the rest of the month. Future growth, this shows that the future growth for the company may not be so good. It says how the PFB forecast will to perform over the next 1 to 3 years based on estimates from 2 analysts. So here it says The forecast earning growth is 11.3 per year above the savings rate, which means they're saving 1.5% of the money they're making, and they're growing at 11.3%. Here it says, well, wait a minute. If they're making 11.3% and the rest of the industry is growing at 25.9%, that's not good, which means this company is not growing as fast. Then you come to the next one and it's like, well, their earnings are forecasted to grow, but not by much, which is what basically the other two summed up. This one says, well, hold on, the revenue is going to be 4.7 per year, and it's forecasted to grow slower than the market, which is at 7.8. So revenue is also like, hey, your revenue is going to go up by 4%. Cool. But the rest of the industrial sector is going to go up by almost 8%. So almost double. Well, actually 5 to 8. And the next one looks at it and goes, well, hold on. So if the revenue is 4.7 per year, that's at least slower than 20% a year. So that's not good. 20% is that magic number. And then last but not least, the return on equity for the forecast is high over the next 3 years. So for the next 3 years, it's return on equity, or the return on basically the stuff itself, is 25%. Pretty good. So here is some growth forecasts over the next little bit. So it kind of breaks it down for you after you look at this on the numbers here. So first off, you can see cash flow. So it shows you that the cash flow, for example, we're right here. That's November. No, it just automatically assumes November 2020, whatever. So right now, when the company filed its last report, this is what it's sitting in. The revenue was 134 million a year. Their earnings is 15 million, and then their free cash in their account was 21, which is pretty good. Then it says, okay, well, hold on. How about, on December 30th, 2020, 134, 15, 23. Well, hold on. That means the company really didn't make more revenue or earnings, but still banked almost $2 million extra, which is pretty good. Next month, 21. So earnings are going to be down. Revenue will be up, and so will be earnings, but the free cash flow will kind of go almost, it's going to go down by a couple million. And then theoretically, December 30th, 2022, pretty much everything's up from now. But mind you, there'll be that dip in 21 and then theoretically up. So they're saying is 2021 may not be the best year for the company. They'll still grow. They're still going to do really good. The revenues are going to go up and all that stuff. But there's going to be a little bit of a dip theoretically and then an up. And you can see that they had some issues with cash flow back in the day, which was fixed. Here is the company's forecasts versus a few other things. So here's earnings versus revenue. So the company, the industry, the market. So the company is sitting at 11.3% earnings. The industry is 25, and the overall market's at 25. So it's pretty low. And it'll break down basically what this is over here, which is cool. And then here is where we get into some of the interesting stuff. You'll notice obviously the massive spike over here. So this is the earnings per growth. And it even shows you how it calculates it and all that stuff. So basically this is just how it earns growth wise and all that stuff. It's pretty interesting. Graphs. Like I said, one of the things I really like about this website is it just gives you a ridiculous amount of information. Then in return on equity, it actually explains some of the stuff down here. It shows you how it actually calculates it. Next steps, explore growth companies. Hey, click on this. Maybe you click on more than 10, then you'll have to pay us. Overall, it's got a historical earnings of 25%. Presses all those checks. Here's its revenue versus its earnings, which is really good. And then here, the more important thing for me is operating expenses, how much it costs to run the business, and how much cash they have. So here's that little cash bump we saw a little while ago. But here it's supposed to be operating expenses pretty much are going to stay at, it looks like around the 18 to 19. It's going to creep up a little bit to 20 it creeped up to 20 in 2019. But then it kind of started going back down again. So operating costs are kind of going down, but the revenue is going up, which is good. So the company is earning more money. Then here's overall the growth. So the company is looking at a 25% growth, probably over the next X amount of years, while the industry is at 11, market's at 12. This is the past 5 years. Sorry, where it looks at basically for the last year and last 5 years, it's outpaced the market. It's outpaced the industries that are the industry. Yeah, it's actually doing really well. Overall, here's the return on equity, return on assets, return on capital. Breaks down everything for you. Financial position. So here, for example, the company has $60 million in assets. Short term. Can't remember the actual length of term. There's an actual numerical thing where what short term versus long term assets and liabilities are. But then they have only $24 million in liabilities. Long term, they've got $46 million in long-term assets, basically things that they're going to own for a very long time. You know, buildings, machines, equipment, things like that. And then their liabilities, things they have to pay out for, is 16. So long-term, there's still an amazing amount of growth potential here, growth possibilities. Now here is where it's very important for the dividend. So for the dividend, we look at how much debt they have versus how much equity, and then right here, cash and equivalents. We want to see this green thing keep going up. As long as they have cash, they'll have a dividend to pay. That's the big thing. And you notice that here, their debt is going down every year. As of September 29th, 2020, their last reporting, $7.9 million in debt. That's really good. You can see here, reducing debt. So the debt to equity ratio has increased from 0 to 12% over the last 5 years. That's because of this right here. Well, 2015 actually would be here. Wait, that'd be 5 years. So 2016, yeah. So it's right in here. They had some issues. So they took on some debt back in 2016. So went from 0 in 2016 to obviously 11.3 million. But then since then it went down a little bit. Yeah, okay. The next year they did take out a little bit more debt, up to 13. And then since then it's just steadily dropping, which is good, which is very, very good. This just shows you overall what they have versus assets, liability, and equity. So right now they have 7.9 million in debt, but accounts payable is 10.9 million. Other liabilities are 22.3 million. And equity is 66. Basically, you want to see this as big as possible. You know, getting paid isn't too bad either. Overall, dividend 1.78. Yes, that's not much. If you compare it to the market is averaging about 5%. The bottom of the market is 1.5%, while the company is sitting at 1.8. The industrial average is sitting at 1.4. Well, the forecast for the next 3 years is not a growth in the dividend, meaning they're expecting the dividend to stay at 1.8 for the next 3 years, which isn't that bad still. Yeah, you can see here, like the big problem that a lot of people are having with this company is the dividend probably isn't going to change. So you can look at the dividend yield, for example, at we'll say it's 2.7% in 2016. Now it's 3%. It's 0.28. Cool and all, right? So this year they increased it when going into 2017. They increased it again going into 2018. Increased it again going into 2020. And then right here, increased it again going into 2021. But you'll notice that the dividend yield percentage goes down because the price of the stock is going up. So we're not looking so much at the dividend yield in this case as much as we're looking at the price. So the percentage is going to go down, but the amount is going up. That's the big thing. We want the number to go up. Now, earnings per share, if you notice, it's basically going through the roof at this point. So that's very good. Basically, as long as their earnings per share is high, that means the company is earning money in comparison to the stock price at a high rate. In this case, I'm going to assume it's $1.03. And as of today, there's no data, but as of let's get to about here, uh, July 30th, 2.5% dividend, aka 3.6 cents, and the price was roughly sitting at around $1.06 per share almost. So the numbers don't sometimes jive with the dates and stuff. Current payout. So right now, their payout ratio, quote unquote, is low. Dividend payments are covered basically by their earnings. So if you take 100% of the pie, being how much money they make, they only pay out 16% of that to shareholders. Cool. Future payouts, same thing. They're looking at a smaller amount because they're looking at in 4 years' time, or in this case, 3 years' time, the company will have grown to the point where they're actually paying 1% less, which isn't actually a bad thing. Overall, management that's in the company have been there for at least 3 years. How much they get paid, their, overall how much the, total compensation slash salary slash company earnings work and all that stuff. The names of the people, what they do, how much money they make per year, how much they own for the company and the percentage that they own. So if you find out that, hey, Mirko Pegya here, the CFO, who's been there for 5 years, who gets paid $272,000 a year, also has almost 0.1% ownership in the company, aka $146.1 thousand worth of shares. Interesting, right? It's kind of cool. But this will show you, like, for example, Will Smith. He's the head of corporate security and in an independent and the non-independent director, whatever that means. He's been with the company for almost 30 years. He only makes $24,000 a year. Think about that. But dude has almost $1 million in shares. These are the people you got to watch out for. Because if he decides to retire and liquidate his shares, he's actually, I think he's the largest stockholder. He has more stock, funny enough, than the chair. Now, mind you, C. Smith, William Smith. Dr. William Hertman Smith, also known as Bill. Okay. Does it say that if he's related to... So my question would be, are these two related? If they're related, they own together almost $1.5 million worth of stock in this company. Very interesting. President of Custom Homes. Dude makes almost $500,000 a year. Theoretically, he owns no stock. But dude's also only been there for a year. This guy's been there for 5 years. Yeah, this is kind of crazy. This dude makes $24,000 a year. He basically gets paid in stock, I think. He must. Like, that's crazy. So here it shows overall, insider trading wise. So this shows you the company itself, what it did with its stock. So in the last 3 months, 150,000 shares were sold by 2 companies that own stock in the company. That's no big deal. Here, one company bought $312,000 of the stock. This is a good way to see if another company might be actually coming in and trying to basically buy all the stocks. Well, here you go, right here. There's insufficient data to determine if insiders, aka people that work for the company, have bought more shares than they have sold in the last 3 months. And then this just shows you here, what companies bought and sold and all that stuff. So you can see, like, say for example, there's a company that keeps just whittling in, just keeps buying more stock, buying more stock, buying more stock. That sometimes could be a warning that could tell you that a company externally to this one is possibly going to be trying to take over the company. Like you can see here, on October 1st, a Atheon Capital sold $5.2 million worth of stock in this company. That's amazing. And since then, a lot of other people have been selling because the price has been going up. So this is always a good thing to watch, where it's who's buying, who's selling. Like these people sold at 16. These people sold $174,000 worth of stock at 21 bucks. It's really interesting to see. Like overall here, private firms own 53.5% of the company. The general public, me for example, owns 35.7% of the stock, or 2.4 million shares. Institutions, banks, brokerage houses, things like that, own 7.9% of stock. And then last but not least, individual insiders, or people that work in the company itself, own 200,000 shares of stock. And then right here it shows shareholders have not been meaningfully diluted in the last past year. So basically, they're not issuing additional shares. That's kind of cool. And here it just shows who are the major holders. So right now, Atheon Capital Corporation, they had 2.6 million shares. The current value is 59.6. It's reduced by 11%. But here's the thing. That is 100% of what they own. And they own almost 40%. So if you look back up, they own 40% of the company, which means they also own the majority of these outstanding shares. Then there's Camel Limited. So these people own 64.33% of this company. And these are the highest people. So these people are all insiders here. Then you got this, whoever this is, Chamberlain Partners. They own $4.9 million worth of stock in this company. Pender Fund Capital owns 6.7 million of this company. It is amazing. Now, here's the funny thing about this. You can invest in these companies probably too, because they're all probably publicly traded. So it's kind of interesting how you can own a stock in a company that the company you own stock in owns stock in. So you can basically yeah, it's weird. Key company information, where they are, what they're traded on, and all that stuff, the number of employees, where they are. They're based out of Calgary, nice. It even shows you where they actually are on the GPS, where they're traded. So they're also traded on the OTCPK in the US. Cool. Yeah, there you go. So that's a breakdown of a stock right there. Yeah, that's about an hour video. So this is actually going to be released probably on Tuesday. But yeah, that's how I basically pick a stock. I go through this stuff and I will look to see, does this stock tickle my fancy? Do I like it? In this case, yeah. Yeah, I do. It's got growth potential. It's got, as you can see here, right? No, it doesn't have the best growth potential. On a 1-to-6 ratio, for example. Can I hover over this? Yeah, so for future growth, it's got a 2 out of 6. Okay. Value-wise, 6 out of 6, because it's 60% undervalued. For the dividend, it's a 5 out of 6, because the current dividend yield is 1.7, but it's still pretty dang good. For health, long term, over the next 3 to 5 years, it looks amazing. It's 5 out of 6. And then for the past, in basically being a really cheap stock and now not being a cheap stock, and the company not really being stupid with their money, they got a really good track record when it comes to management and pretty much everything else. It's a really good stock to basically watch and probably to invest in down the road. Like I said, the future of the company, it's probably going to be one of these stocks that goes whoop, and then it'll just kind of go boop. It'll hit a certain point and then we'll flat, or it'll keep going up, and then one of the other major companies will probably buy it or something like that. But yeah, so that's how I pick a stock. I look at Simply Wall Street, break down the stock, and I may have already bought a couple hundred of these. I'm not saying I didn't, but I'm not saying I did. But yeah, so there you go. With that in mind, between this episode and the next one, I'm going to be spending my $401.68 on PFB Corporation. One of the things I have to watch out for, though, is my weight ratio. Sitting at 2.219. You don't want to get too high on that number, but we're going to be definitely throwing more money at this company. $400 worth. We already have $1,100 there. We're going to be at $1,500. It will be the stock that I have the most amount of money in. We'll see what's going on, though. Fingers crossed. I mean, in the end, you never know. Thanks for watching. See you in the next video. Bye-bye.